Hey everyone, this is Trevino back with another video as part of our new construction series where we are breaking down a few different concepts and things to know when you're doing new construction. So in today's video, we're going to talk about what is loan to value, so LTV ratio, and what is loan to cost. So in new construction, maybe you've heard a few of these terms, LTV and LTC, right? So it looks like just an acronym like any other acronym. However, these are very important concepts to understand, right? Especially when you're doing a new construction deal. So LTV would be known as your, let's make this green. You can call that loan to value. And your LTC is known as your loan to cost, right? So in this video, we're gonna explain and break down what these ratios are and why they're important when you are doing a new construction deal. So let's get to it, y'all. All right, everyone. So our first ratio, we'll say this is LTV, right? So as we mentioned before, this is our loan to value. So at the end of the day, these are ratios, right? So your loan to value ratio is the amount of the loan compared to the appraised value, right? So let's say our ratio here is the loan and then compared to the appraised value. And the reason for that is that many lenders will have an appraisal ordered and their loan amount is gonna be based off the appraised value, right? So it's one thing for you to think that your property is gonna appraise for 400K, but if the appraisal comes back at 350, your lender is going to, they're gonna do the loan and finance the deal based on that 350K, right? So basically, this ratio measures the risk that a lender is taking on by funding a deal, right? Because at the end of the day, for a lender, their big concern is risk. How much risk is the lender taking on? If it's too much and it's too risky for them, a lot of times they'll tell you no, they can't take on the deal, right? So as the LTV increases, the risk for the lender increases as well. So if you have a high LTV, that means high risk for the lender, right? Because there's basically a potential for loss if the borrower does not pay back the loan, right? So if there's a high loan to value ratio, it means higher risk for the lender. And this is important when you are speaking to a lender because a lot of times they can throw out these acronyms and it's very important to understand what they're talking about, right? All right, so to further break down what LTV is, we can call it the amount owed on the loan, right? And then we can do, that'll be a division sign divided by the appraised value of the asset, right? So just to recap from before, the amount owed on the loan and then divided by the appraised value of the asset. And then obviously it's going to be a percentage. So, we can say times 100, right? All right, y'all. So let's get into an example here. So if you're buying a house and the house appraised for 300K, right? So your house, it appraised for 300K. And let's say your loan amount is 220, right? So we'll say loan amount is 220, right? So we'll say your LTV ratio is, we will do 220K and then divided by the 300K appraised value. And of course, times 100 would equal 73, yeah, we'll just call it roughly 73%. All right, so that is your LTV. That is your loan to value. All right, so now we have your LTC, which is your loan to cost, right? So this is the second ratio you should know about. So basically, it's the amount of the loan compared to the total project development cost. So if someone's talking about cost really means, you could say total project costs. total project cost. Basically, how much money is it going to take, the land plus construction included, to do the deal, right? So let's go a bit further and illustrate exactly what this means. So if someone is talking about total development cost, right? Let's say total dev cost for development. Total development cost, right? That would be the purchase, right? So purchase price plus construction, right? So that is exactly what it means. When someone says total development cost, that is purchase plus construction. So the amount to purchase the land, right? Here's your beautiful lot that you're going to build on, and to do the work, right? And the construction. And just to get familiar with the verbiage here, someone could call this your all-in costs, right? So basically all the money you're putting in, your purchase plus your construction costs, right? It's basically just showing how much money you're putting into the deal. So let's go through an example. So let's say that you purchase a property for 100K, right? So that is your purchase price, 100K. And it needs 50K worth of work, right? So your 50K rehab costs. All right, so pretty easy math here. We're gonna have our 100K plus our 50K, right? Equals 150K. And this would be our total development cost, total dev cost, right? So you can say your all-in cost, your total dev costs are 150K, right? Now, let's see where exactly LTC comes into play here, right? All right, so if your lender comes in and says they can finance, they say, hey, Jack, we can finance 90% LTC. All right, what does that mean? 90% loan to cost would mean, all right, let's say LTC equals, they're doing 90%, right? And then multiplying by the 150K worth of dev costs, right? So if you do 90% times 150K, that would be 135. All right, so let's remember where the 150K came from. It's our purchase price of 100K plus the 50K is 150K. So this is our total dev cost. Now, LTC is our loan to cost. So if your lender comes in and says they can finance 90% of this 150, they're saying they can finance 135K, right? Which basically means, that your lender would finance this dollar amount. This is how much the lender's financing. So that would mean your down payment is the difference, right? So people are always asking if they're doing new construction, what's it to me, right? How much skin do I have to put in the game, right? What's my down payment? So in this case, as a builder, your down payment would be 15K down payment, right? So the LTC basically measures risk for the lender and how much of your total cost they can finance. So in this case, they're financing 90% and they're wanting you to put 10% down. So while this isn't always true, different lenders can structure things differently. So if you have a high LTC, right, high loan to cost, this means that the lender is financing a lot of the deal, right? So if you have a high loan to cost, I don't know, let's say something like they're financing 92% of the total cost, right? So there could be a higher interest rate. So maybe they want it at 11% or 12% or something like that, right? If you're doing private money construction. All right, y'all, so I hope that explains a bit more about LTV versus LTC. Really just the loan versus the appraised value and the loan to the total development cost. So I hope that explains a bit about this verbiage, this sort of construction knowledge you would need when you are doing a new construction project. And again, this is based on my experience financing flips, new construction development across the state of Texas, guys. So if you did find this video to be helpful to you in your new construction journey, make sure to like, share, and subscribe, y'all. Let us know what you think. Are you looking to do new construction in Texas? Have you already done new construction? Are you looking to partner up? Whatever it may be, comment below. Let us know what you think, and we'll talk to y'all next time.